Okay, we are now going to be looking at 3.16, so I'm not going to spend too much time on it. We've done a lot of questions up until this point. If there's anything you're unsure of after watching the video and working through the memo and the notes that I gave you, so the general journal entries, then please just ask and I'll help you. So the pre-adjustment trial balance, you're very familiar with at this stage. The only difference here is I told you to refer to adjustment 1 because this is the first time that they've given us ordinary share capital, but this isn't our opening balance, because I'll show you now when we get to adjustment 1, this balance includes some shares that have been issued. So this isn't our opening balance. Okay, then everything else is pretty straightforward, but then the only difference is here it says shares in Uptown Limited, so that's just another financial asset that we have. It's just a different type of financial asset. So instead of a fixed deposit, we now have a line item called shares in Uptown Limited that also goes under financial assets. So there's nothing too funny there. Then the rest of the pre-adjustment trial balance is straightforward. So I'm now going to work through the adjustments. So I'm going to start with adjustment number 1. And they told us that the authorized share capital comprises of 600,000 shares. So that's this line item here. You have to state how many authorized shares there are. Then it says on the 1st of March, which is the beginning of our financial year, the company issued 50,000 shares at 7 Rand each. So that's entered here. They told us that during the year we issued 50,000 shares at 7 Rand each. The reason why we have to separately disclose that, and we can't just include that in the balance at the beginning of the year, because we issued these shares at the beginning of the year, but we need to state all the shares that were issued during the year. So even though it's the first day of our financial year, we have to take it out of that opening balance and separately disclose it. So we issued 50,000 shares at 7 Rand each. So that means that we need to deduct that from that balance they gave us in our pre-adjustment trial balance to get our balance at the beginning of the year. And the reason that we know that is because it says this has been properly recorded. So that means that this 350,000 has been recorded and is now included in this balance that they gave us in our pre-adjustment trial balance. So in order to get the correct balance, we take the pre-adjustment trial balance minus the 350, so the shares that were issued at the beginning of the year, to get our opening balance. And that's our opening balance. And then we had, per our pre-adjustment trial balance, 500,000 shares. We issued 50, so that means we had 450 at the beginning of the year. So this is the first time that we've had where the ordinary share capital in our pre-adjustment trial balance isn't the opening balance. So if this happens in a test, I'm sure most of you do your tests in pencil because you're allowed to, and that's the reason why. Because if you just took your pre-adjustment trial balance and put all the opening balances in your financial statements, when you got to the adjustments, you would have now seen that the 500,000 is not your opening balance at the beginning of the year, and you would have to then just correct that accordingly. Adjustment number 2, they told us that that an old delivery vehicle was sold for 27,000 Rand, so that's the selling price, and no entries have been put through. So this was on the 31st of January, so it's 1 month before the end of our financial year. And the cost price was 153,000, and the accumulated depreciation up until the beginning of our year is 109,200, and vehicles are depreciated 20% annum on cost, and the purchaser promised payment to date, but it has not been received. So that's why we have this line item here where we debit accrued income of 27,000, which goes under note number 5, trade and other receivables, because we didn't actually receive the money from the disposal of the delivery vehicle. The person still needs to pay us for that. Okay. So we have and because it's on So we need to take the accumulated depreciation of the vehicle for the beginning of the year, which is the 109,200. They gave that to us. So that's the opening balance of the accumulated depreciation. And we also need to take out the current year's depreciation up until the date of disposal. But we don't have that amount, so we need to calculate it. So you take the cost price times 20%, and I apportioned for 11 months of the year because we disposed of it at the end of January, which is 1 month before the end of our financial year. So you still need to, like normal, up until date of disposal, account for the current year depreciation. So this goes in your statement of comprehensive income under operating expenses, and then accumulated depreciation negative asset goes under note number 3, your fixed assets. So this relates to the disposal, and this is the current year depreciation. So you still need to account for the depreciation like normal because it hasn't been done up until date of disposal, and that's what the first part of the journal is. And then the second part of the journal is we're taking out the total depreciation up until date of disposal, the cost of the vehicle, and then the selling price, and then the balancing figure determines whether we've made a profit or a loss on disposal. But we've made a profit on disposal because our carrying value on date of disposal, and that's the amount that goes under note number 3, that line item that says disposals at carrying value. So the carrying value is 15,000 and we sold it for 27,000, so we made a big profit. So we have profit on disposal, which is an income, which goes in your statement of comprehensive income under operating income. And then I missed it, and I went and carried on with number 2 at the bottom, and I even highlighted here. We had to calculate the depreciation of the remaining vehicles because we didn't dispose of all vehicles. We only disposed of an old delivery vehicle. So we need to calculate depreciation on the remaining vehicles, and I said here that I will ensure that in an exam that it stipulates that the rest of the vehicles are to be depreciated, because at this point there's no reason to just assume that the rest of the vehicles need to be depreciated. They only said no entries have been put through for the sale, but they didn't say anything about the rest of the vehicles. So I'll make sure that it does specifically state that in the test. So in order to determine the vehicles that we still have left after the disposal, I took the cost of the vehicle, so the total cost of the vehicles per our pre-adjustment trial balance, minus the cost of the vehicle that was sold, and that then gave us the remaining vehicles that we had for the entire year. And depreciation is at 20% on cost, so we multiply by 20%. We don't need to apportion because we had it for a full year, and we get an amount of 217,400. So we debit depreciation, which is an expense, statement of comprehensive income, and then your accumulated depreciation goes under note number 3, your fixed assets. Okay, then number 3, they tell us to depreciate equipment by 10% per annum on cost. Okay, then there's a bit of a trick here. They tell you to note to inspect the cost and accumulated depreciation before you arrive at your answer. So before I carry on with that, the rest of the sentence, the reason that they do that is because they told us that it's 10% per annum on cost. So if we calculate 10% on cost, the depreciation amount is 57,000, and that seems pretty straightforward. But if we work out the carrying value of all the equipment we had at the beginning of the year, you take your cost price minus your accumulated depreciation, and we have a carrying value of 24,000. So the issue comes in, we cannot account for the full depreciation because we cannot account for the full depreciation of 57 when we only have 24,000 rands worth of equipment left. So that's why they tell you to take note of the cost and the accumulated depreciation. Then they told us that there are 120 items of equipment and they were originally all bought on the same day. So the reason that they do that is because now we need to account for depreciation, but we limited to the carrying value, and we have 120 items of equipment, not just one. So do you remember when we said when we depreciate an item but we still have it, so we haven't sold it, we are limited to the carrying value, and we make sure that we end up with a carrying value of 1. So just to represent that we still have that asset in our books instead of writing it off completely, because we do still have it. We didn't get rid of it entirely. We didn't sell it. So we needed to reflect 1 rand in our books so that it shows that we still have it. And the reason that they told us is that we have 120 items of equipment, not just one item of equipment. So instead of just having 1 rand as your carrying value, you're going to have 120 rand. So it's the 1 rand carrying value times the 120 items of equipment. So that means that the depreciation that we account for is the 24,000 rand carrying value minus the 120 rand, and we get 23,880. So that's the depreciation we're going to account for, because if we account for depreciation at 23,880, we end up with a carrying value of 120. So here's our depreciation journal for the equipment. Okay, so that's why you always need to make sure. Luckily in this instance they told you to watch out, but in a test this could be asked, and there might not be a sentence saying make sure that you don't over depreciate, because you might have a carrying value that is less than the total current year's depreciation. But you would hopefully pick that up when you complete your fixed asset note, because you would see you have a carrying value of 24, and if you say had to then put in the total 57,000 here, you would end up with a negative carrying value, and that's not correct. You can't have a negative amount of assets in your business. So hopefully then you would pick up that you need to limit your depreciation. Luckily in this question they told you to watch out for it, but going forward in a test you could be asked this and there won't be any hints indicating that. Okay, then number 4. Number 4, we've done an entry like this a lot. So debtor return stock, so you need to account for the return by the customer. So decrease sales and decrease how much the debtor owes you, and you've got to increase the stock in your business because the debtor return stock, and then decrease your cost of sales. And then furthermore, we went and returned it to the original supplier, so we need to decrease how much we owe our creditors because we can't owe them for stock that we've returned, and decrease the stock from our business. Okay, number 5. Number 5, I don't agree with the way that they've accounted for it, so I'm going to show you how I accounted for it. I'm going to confirm with Mrs. Henry regarding this entry, but as far as I'm concerned, the memo is incorrect because you're not allowed to offset transactions in the way that they did here. So what happened was they told us that during a burglary at the shop, stock costing 42,000 rand was stolen. Okay, so here's your normal 42,000 rand stolen. So you have your loss due to theft, which is an expense, goes in your statement of comprehensive income, and you decrease your trading stock because you no longer have this trading stock. But if you go to the memo, you'll see it goes on to say that the insurance company agreed to pay 33,000 rand and it will be paid in the next financial year. So what they did was they then took a loss due to theft, 42,000, and they decreased the loss by the amount that is expected to be received by the insurance company, and then got a loss of 9,000 instead of the full 42. But I don't agree with the way that they've done this, because you cannot just offset transactions like this. You cannot offset income and expenses like this. The insurance proceeds is operating income, and it should go under operating income. So you should have a line item called insurance proceeds, and it should say 33,000. It shouldn't decrease the loss due to theft. You shouldn't offset income and expenses like this. So I will confirm with Mrs. Henry regarding this, but I don't think this is correct. So you should have a loss due to theft line item that says 42,000, and then insurance proceeds 33,000 under operating income. and that's how I did my journals, was based on that. I then debited accrued income, which is an asset, so it goes under note number 5, trade and other receivables, because it says that we haven't received it yet. And I credited insurance proceeds, which is income, in your statement of comprehensive income. I didn't credit loss due to theft, which is what they did. So I don't think that's correct, because you cannot offset income and expenses. It's not allowed. Okay. Then number 6 is a transaction we've done many times before. So an employee was omitted from the salaries journal, so we just have to account for their salary. So nothing funny here. It's exactly like it was before. You account for the gross salaries, the amounts owed for pension, SARS pays you in, and medical aid, and we haven't paid the salary, so it goes against creditors for salaries. Then they told us that the business contributes 2 Rand for every 1 Rand deducted. So this means that the medical aid contributions and pension fund contributions, you just need to multiply by 2 to get the employer contributions. And then unlike the previous activity where we took it against medical aid contributions and pension fund contributions, which were expenses, they told us that the employee contributions are also debited to the salaries and wages. So that's why I took it against salaries and wages and not medical aid contributions and pension fund contributions. So you need to just always follow the instructions. Okay, then number 7, it says all the insurance premiums have been paid up until the 31st of May. So the 31st of May is 3 months after our financial year end. So we have 3 months that have been prepaid. So we have a prepaid expense, and we got to decrease our insurance expense, and we'll recognize the expense next year when we've actually incurred that expense. Okay. Then number 8, the loan statement reflects the following. So we have the opening balance, and they told us that there's a repayment. So this is the balance after the repayments, and that's the same balance that we have per our pre-adjustment trial balance. Then we have a balance at year end, and then they told us that the interest hasn't been accounted for, and the difference is the interest, because this is what we have per our pre-adjustment trial balance. So that's what you would currently have as your opening balance in your statement of financial position, and this is what the closing balance should be. So your statement of financial position must reflect this closing balance, and in order to get there, we need to account for the interest, which is 57,000. Okay, number 9, dividends of 61,000 are receivable, so it's accrued income because we haven't received it yet. So that's note number 5, trade and other receivables, and then this is interest income, which is note number 1. Then number 10 says the physical stock count revealed the following. So just like normal, you need to get your opening balance and then account for any adjustments that have taken place to get your adjusted opening balance of your trading stock. Then you get your balance per your stock count, and the difference is either your surplus or your deficit. In this instance, it's a deficit because our stock count revealed a lot less stock than what we thought we had, so we have to account for the trading stock deficit expense in the statement of comprehensive income, and we credit and decrease our trading stock with the deficit so that we get to the closing balance of the physical stock count. And then the same with the packing materials on hand at year end. You just decrease your packing material expense and you take it to consumable stores on hand. Okay, number 11, the provision for bad debts is to be decreased by 1,800. So you then decrease your provision by debiting it, and your adjustment is then credited, which is an income in the business. So it goes under operating income in the statement of comprehensive income. Okay, number 12. Number 12 is a bit complicated, but it is pure maths. So they told us number 12, the rent has been paid 1 month in advance. So before even reading the next line item, it's just like normal. We want to calculate the prepaid expense, so how much has been prepaid. and we want to calculate what the monthly rent amount is. But the problem with that is we can't just take the total amount of rent expense and divide it by 13. So we can't take that and divide it by 13 payments. Reason being is because they told us that the rent increased on the 1st of November. So that's where the trick comes in, is to now determine the monthly rent amount when an increase took place during the year. So I started with the timeline, which consists of our financial year plus the period which was paid in advance. Then here on the 1st of November, so for 4 months, there was the increase, and this amount will also include the increase. So now to determine what the monthly rent amount is, we're going to say the monthly rent is X. Okay, so that's what we're trying to determine, is X. How much is the monthly rent? So the total monthly rent amount should be equal to 8 months times the rent, the monthly rent amount, plus the 5 months, so the 4 months in our financial year that included the increase, plus the 1 month that was paid in advance. So 5 months times the normal monthly rent plus the increase. So that's what I've reflected here for this period, is the rent is then the normal monthly rent amount being X plus the increase. And then you solve your equation. So you solve for X and you get a monthly rent amount of 17,400. But then you need to remember that the rent that was paid in advance includes that increase. So you can't just take 17,400. You need to take the monthly rent plus the increase, which is the 17,400 plus the 1,350, and you get 18,750. And that's your prepaid expense amount. So you debit prepaid expenses, which goes under note number 5, trade and other receivables, and you decrease your rent expense by 18,750. Then number 13, a supplier overpaid commission, 6,600. This is offset against future income. So this just means that income, we are decreasing our income in the statement of comprehensive income, and then recognizing income received in advance, note number 9. So it was just commission income that relates to the next financial period. So we need to decrease the commission income. Then number 15, these are amounts owed. So it's just accrued expenses, which is note number 9. So these are expenses that still need to be paid, and then you account for the expenses. Then number 16, the directors decided to repurchase 20,000 shares, and the repurchase price was R6.40 per share. So we've done this before. The only difference is here is that it says an electric transfer has been put through, but the bookkeeper debited the amount to sundry expenses in error. So this means that it has been paid, it has been done. That means that our bank balance in our financial statements is correct because the payment's been made, and that bank balance will then agree to our bank statement. That's always the aim, is it needs to agree to our bank statement. So it means that the electronic transfer has been put through and it was done correctly, but then instead of the bookkeeper debiting our bank in our books, he accidentally debited sundry expenses. So you'll see that's why I've then credited sundry expenses instead of crediting bank for the payment that was done. But we don't need to now further go and credit bank again because the EFT has been put through, so we can assume that the bank balance per our statement of financial position is correct because we would have agreed it to the bank statement. Okay, so we credit the sundry expenses with the amount paid to buy back the shares, so it's the number of shares multiplied by the price paid. Then debit ordinary share capital, so you decrease your equity by the number of shares bought back times the average share price. And the average share price I took by getting the number of shares that we had in issue at this point and the total rand value, and I got this from the pre-adjustment trial balance, and the average share price is 5.34, and this goes under note number 7. You'll have a line item that says 20,000 shares repurchased, average share price 5.34, 106,800. Then you debit your retained income with the premium portion, so the extra portion you pay to buy back the shares. So it's 20,000 times by the difference between the price paid to buy back the shares and the average share price, and this then goes under note number 8. You'll see it says the repurchase of 20,000 shares, and then in brackets you say it was R1.06 above the average issue price. Okay, and then the last adjustment is they tell us that a final dividend of 45 cents per share has been recommended. The shares repurchased did not qualify for the final dividend. So that means that so that means that the shares that we bought back did not qualify for the dividend, so we need to take the number of shares that we actually have in issue at the end of the year. If we include the 20,000 shares that we bought back, then we're essentially paying dividends to shareholders that don't exist because we bought back those shares. So we take the 480,000 shares times 45 cents, and you debit your dividends on ordinary shares, which goes against your retained income note. Note number 8, it decreases your equity. And then you credit shareholders for dividends liability, which is note number 9, trade and other payables, because we still owe the shareholders these dividends. Then they told us that the income tax is 30%, so you just take your net profit before tax times by 30% to get your income tax amount. And if you do your T account like normal, this is your provisional payments, and now the income tax exceeds the provisional payments that were made, so we end up with a credit balance, which means that we owe SARS money at the end of the year. So it goes under note number 9, trade and other payables, and we have a closing balance of 135,600. Okay, so I will confirm this insurance proceeds that I referred to, but as far as I'm concerned, the memo is incorrect, and that is the correct way to do it, because you cannot offset income and expenses. You're not allowed to offset. So rather do it the way that I did it. And then if there's any adjustments that you're unsure of, especially like with this rental amount, please just ask me and I'll re-explain it, because this is a good question that could most definitely come up, if not now in your June paper, in your final paper, because I know government papers love to incorporate questions like this, because it's a pure mass calculation in order to get to the correct amount. So if you're unsure of that, please just ask and I'll re-explain it. And then if there's any other adjustment that you're unsure of, please ask and I will help you.